Most people are trying to get ahead financially, but they're unknowingly doing things out of order. They invest before building a safety net, or they focus on credit card rewards before killing high-interest debt, and then they're confused about why nothing seems to stick. And I get it. I was the same way when I first started handling my own money. I'm Sam, and back in my early 20s, I was so eager to become an investor that I shoved everything into brokerage accounts and stocks because I thought compounding would carry me. That's actually why I started this channel, so I could break down finance and investing concepts in a simple, practical way. By the way, this video is for educational purposes and isn't financial advice, but it's what I wish I'd known back then. Meanwhile, I had zero emergency savings. When I got hit with a surprise dental bill, I had to sell stock at a loss just to cover it. That moment felt like I had rewound my own progress. It taught me something crucial. The right steps in the wrong order can still set you back. So what we're going to do here is walk through the smartest order to invest and manage your money. Not the hype version people throw around online, but the grounded approach real people actually need in real life. Before investing, before paying off debt aggressively, before chasing returns, you need a safety cushion. Now, let me tell you something embarrassing. I used to think emergency funds were for people who were bad with money. I figured being smart would protect me. Turns out life doesn't care how smart you are. It will still throw a surprise at you every now and then. One month, it was a cracked windshield. Another month, it was a medical copay. Another time, it was my phone randomly dying, forcing an unexpected replacement. With no savings, every little surprise becomes a crisis. Your first goal is simple: $1,000 to $2,000 tucked aside. Just breathing room. You'll eventually build more buffer later, but this starter buffer prevents panic. If you work for a company that offers a 401k match and you're not taking it, that's basically leaving free money on the table. There is no investment on earth that consistently beats free matching. I didn't understand this at first. In one of my earlier jobs, the company matched 3%. I was only contributing 1% because I wanted more cash in my pocket. When a coworker explained I was literally declining free money, I felt like I'd missed a secret cheat code. So after your starter emergency fund, your next priority is to contribute enough to your retirement plan to get the full employer match. Not more than that yet, just the match. And by toxic debt, I mean high-interest stuff. Credit cards, payday loans, financing plans with crazy rates. If the interest rate is above your expected investing return, you're going backwards. I once had a friend, very smart guy, very analytical, who was investing in index funds while also carrying a credit card balance with a 19% interest rate. That's like trying to fill a bathtub while the drain is wide open. You don't need to kill every bit of debt immediately, but the high-interest stuff has to go. It's silently eating your future. This is where you scale the safety net. Aim for 3 to 6 months of living expenses. Let me tell you why this matters. When the company I worked for went through restructuring, a bunch of us were suddenly unsure if we'd still have jobs the next quarter. I wasn't fired, thankfully. But that moment made me realize how fragile a single paycheck can be. After that, I got serious about building a bigger cushion. A full emergency fund isn't about paranoia. It's about peace of mind. Money becomes freedom, not stress. All right, let's keep moving. Once you've handled high-interest debt and built that emergency safety net, now you can actually start investing more aggressively. This is where you go beyond just getting the employer match. I remember a time when I didn't think about retirement at all. It felt too far away, like future me's problem. Then one day I was having dinner with an older colleague from work, maybe in his early 60s. He looked tired, like really tired. At some point in the meal, he said, "Sam, the biggest financial mistake I made was waking up at 55 and realizing I had to keep working whether I wanted to or not. Don't end up like me." That hit hard. You're not investing for old age. You're investing for the option to stop working before you burn out. So at this stage, aim for something like 10 to 15% of your income toward retirement. If you can't hit that right away, don't panic. Just move toward it over time. The key is direction, not perfection. This is where we talk about IRA options, and I'm going to keep it straightforward. A Roth IRA means you pay taxes now, and your growth is tax-free. If you expect your income to go up over your lifetime, this is usually the better deal. Traditional IRA means you defer taxes until retirement. How do you pick? Here's a simple way I explained it to a friend once. If you think you're in a lower tax bracket today than you will be later in life, go Roth. If you're already a very high earner, traditional might make more sense. I personally like Roth because I don't love owing government money later in life. I'd rather deal with it now and let the winnings grow untouched. This is where you get to play offense. After maxing tax-advantaged options, you can start investing in a regular trading or brokerage account. This is for index funds, ETFs, individual stocks if you're brave, long-term growth plays. This is also the account that gives you flexibility. Because unlike retirement accounts, you can access this money anytime without penalties. Let me tell you about a mistake I made. In my mid-20s, I had all my money either in my checking account or my retirement account. Nothing in between. So when I wanted to move to a new apartment, I actually had to pause retirement contributions to save extra cash. If I'd already had a brokerage account with some long-term investments, I could have sold a little of that instead. It taught me that having layers of money is important. Short-term, medium-term, and long-term. I'm not going to preach real estate like some people do, because it's not magic and it's not effortless. But if you're in a position where you've got no high-interest debt, you've got 6 months of savings, you're putting money into retirement, you're investing consistently, then yeah, something like real estate can be a solid next step. A friend of mine bought a duplex and lived in one side while renting the other. Smart move. The rent covered most of his mortgage. That's the kind of real estate investing that actually works. Not gambling on Airbnb markets. Not buying houses you can't afford. Not manifesting passive income. Just practical, sober, numbers-based decisions. Now, if you've noticed something, this entire structure has a theme. Before you invest, you protect. Before you chase growth, you create stability. You build a financial foundation in layers. That's how you avoid ever being in panic mode. And maybe I'll leave you with this thought for today. There was a point in my life when I checked my bank balance every morning because I was anxious. I was living paycheck to paycheck, even though I earned decent money. Today, I barely check it. Not because I'm wealthy, but because I'm secure. The anxiety is gone. That's the real reward of good financial planning. Not being rich, but being calm. All right, let's keep going. This part is important because your emotions will sabotage your money faster than any bad investment. Let me tell you about younger Sam. I once bought stock in a company just because every financial influencer on the internet was hyping it. You know that feeling where you think, everyone else is getting rich except me? So I jumped in. The stock dropped 30% in the next 2 months. I panic sold and locked in the loss. Then, 6 months later, that same stock bounced back to even higher than before. My mistake wasn't investing in the stock. My mistake was investing with emotion. If you're buying because you feel left out, that's a bad reason. If you're selling because you're scared, that's a bad reason. Investing should feel boring, like watching grass grow or paint dry. If your heart rate goes up, you're probably doing it wrong. Imagine planting a tree. You don't dig it up every few weeks to check the roots. You water it, you wait. Time does the work. Wealth is the same. I had a mentor once who told me, rich is fast, wealth is slow. At the time, I didn't get it. But now I do. People who chase quick money usually end up losing money. People who steadily invest, month after month, year after year without drama, they usually end up quietly comfortable. Here's the quiet truth wealthy people understand. You don't need huge returns. You need consistent returns. A steady 7 to 8% annually will make you wealthy over time. You don't need 50% moonshots. I don't trust my own willpower. If I have to manually transfer money into investments every month, there's a chance I'll skip it just this once. So I automated my deposits. Every paycheck, money to savings, money to retirement, money to brokerage. It's like your future self is putting money away without consulting your present self. Here's something funny. I once forgot that I had an auto investment set up for about 2 years. One day I logged into that account and just stared at the balance. I felt like I'd stumbled onto secret buried treasure. That was money I never had to decide to save. It was just happening in the background. This one is sneaky. You start earning more money, maybe a promotion, a raise, a side gig taking off, and suddenly, your rent goes up. Your car gets more expensive. Your dinners become fancier. Your hobbies become pricier. Your vacations get nicer. Before you know it, you're back to living paycheck to paycheck, just at a higher income level. I had a period where I was earning more than I ever had before, but I wasn't saving any of it. I was just buying nicer versions of everything I already had. Lifestyle creep feels harmless. It feels earned, but it steals your future. A little splurge is fine, but don't upgrade everything. If you get a raise, try to live like you didn't. Let that extra money work for you, not your image. Let me pause here for a second, because I want you to really feel this next part. You don't win at money by being perfect. You win by being consistent. Even if you start late, even if you make mistakes along the way, even if you don't know everything. I'm not some prodigy investor. I'm just someone who stopped making emotional money decisions and started making structured ones. Good, let's keep moving. You know what most people do when the market drops? They freak out. They check their accounts every hour. They start Googling, is this the next crash? And they start pulling money out. But experienced investors do something very different. They buy more. I'll tell you something that shifted my perspective. During a market dip a few years back, I was talking with a friend of mine who's been investing since the early 2000s. While everyone else was panicking, he was actually smiling. He said, "This is the clearance sale I've been waiting for." At first I thought he was just being optimistic, but then I realized something. If you liked a stock or index at $100, why would you not love it at $70? Most people see red numbers and think danger. Investors see red numbers and think discount. Look at any long-term market chart. Your brain will notice something important. Market downturns don't destroy long-term wealth. Panic does. A lot of people misunderstand diversification. They think it means owning 50 different stocks. But that can just turn into chaos. I prefer the simple version. A broad market index, maybe a bond fund, maybe one or two sector or thematic ETFs, and only a small portion in individual stocks if you truly want to. If your entire portfolio depends on one company's success, that's gambling. If your portfolio depends on the whole market's success, that's patience. Someone once asked me if I ever worry that the market will go to zero. I said, if the entire US stock market goes to zero, we've got bigger problems than investing. At that point, we're talking apocalypse, not retirement planning. This one's overlooked. There are times when investing is the wrong move. Like if you're about to need that money soon, or if you're still drowning in credit card debt, or if you don't have emergency savings yet, or if investing is motivated by FOMO. I had a moment when I caught myself getting tempted to put money into a fast-moving stock, even though I needed that cash for an upcoming expense. If I hadn't stopped myself, I'd have been forced to sell at a loss just weeks later. Sometimes the smartest investment decision is restraint. This one's not technical, it's psychological. Money humility means accepting that. You don't know everything. You won't time the market perfectly. Sometimes you'll be wrong, and that's okay. I once asked a very wealthy investor about his biggest financial skill. He didn't say analysis, or forecasting, or stock picking. He said, "I'm good at being wrong without losing confidence." That stuck with me. You don't need to be a genius, just grounded. This is where quiet wealth is formed. When markets are booming, everyone calls themselves an investor. When markets crash, most of those investors disappear. If you stay steady through both, you win. There was a period when everyone on social media was flexing their gains. Crypto millionaires, meme stock traders, overnight success stories. I'll be honest, it was tempting to abandon the fundamentals. But a year later, most of those people evaporated. They lost it all because they chased heat instead of fundamentals. Meanwhile, those who stayed boringly consistent are still moving upward. Let me share something personal. There's this calm that comes with financial security. It's subtle and powerful. It's waking up and knowing that you don't have to constantly think about bills. It's knowing that a broken appliance or a car repair won't wreck you. It's knowing you are slowly, quietly building wealth in the background. It's like breathing gets easier. Money doesn't solve everything, but it sure solves money problems. And that frees up so much mental space for everything else in life. All right, let's bring this home. A lot of people think making a high salary means they're doing well, but income is just speed. Wealth is endurance. I know someone who earns a lot more than I do, at least on paper, but he spends almost everything he makes. New gadgets, new car, constant upgrades. His bank balance looks like a revolving door. Then there's another guy I know. Steady job, nothing fancy, but he saves diligently and invests quietly. 10 years from now, guess who's going to be more financially free? The person who kept money, not the one who just earned money. Wealth is what you don't see. It's invisible. It's sitting silently in accounts. It's compounding quietly in the background. Consumer mindset, how much can I afford to spend? Investor mindset, how much can I afford to keep? When I started shifting from buying things to buying ownership, everything changed. Instead of buying a nicer TV, I bought shares of the companies that make them. Instead of upgrading my wardrobe constantly, I invested in the businesses that sell clothing to millions. At some point, I realized I'd rather own the factory than buy the product. That shift is subtle, but life-changing. Comparison is poison. It doesn't matter if someone else got wealthy faster or earlier or luckier. You don't know their real situation. Maybe they inherited money. Maybe they live with parents. Maybe they're buried in unseen debt. Maybe they make risky bets that just happen to work temporarily. Everyone starts from a different point. You're not racing them, you're building your life. There was a time I used to compare myself to friends who were ahead financially. It made me feel behind. Then one day I realized feeling behind never helped me get ahead. Focus on your own lane. People talk about becoming rich like it's about Lamborghinis and mansions. That's not the real win. Real wealth is waking up and deciding how you want to spend your day. Maybe that's working. Maybe it's not. Maybe it's traveling. Maybe it's reading on your balcony with a coffee. Maybe it's spending time with your kids. Maybe it's building something creative or meaningful. Financial freedom doesn't mean doing nothing. It means having the option to do what matters. I have this small ritual. Sometimes I sit with a coffee in the morning and think, if I really wanted to, I could stop working someday. That knowledge changes how I live today. I don't feel trapped by obligation. I feel guided by choice. There's nothing glamorous about it. You save consistently, invest consistently, avoid emotional mistakes, ignore fads, trust time. It's not sexy, it's not dramatic, it's not viral, but it works. I used to think wealth would come with a big moment. Some windfall, some lucky break, some jackpot feeling. But it didn't happen like that. It happened slowly, incrementally, almost invisibly. One day I looked at my financial accounts and realized I'd crossed a threshold, not because of any one big event, but because of hundreds of small decisions made over years. That's how real wealth feels, subtle. You reach this point where you don't worry about finances constantly. You stop checking your balance every week. Your investments start creating more growth than your hard work does. Your money starts working harder than you do. That's a cool moment. It's like the shift from pedaling a bike uphill to suddenly hitting a long downhill slope. The effort flips. Work stops being desperate. Life stops feeling like a financial tightrope. You finally get breathing room. Look, I'm not telling you how to live. I'm just telling you what I wish I had understood sooner. Money doesn't make you happy. But money makes being unhappy a lot easier to fix. When you don't have debt breathing down your neck. When you're not stretching your paycheck. When you've got savings tucked away. When your investments are growing quietly. When emergencies don't scare you anymore. Life feels lighter. And if you're not there yet, that's okay. I wasn't either. You just start at step 1, then step 2, then step 3. Layer by layer. You don't need to sprint. You just need to keep walking in the right direction. Start now, start small, but start. Your future self will thank you.